Hi everyone, and welcome to this Drawbacks Trader Education session. In today's webinar, we're going to be discussing swing trading. Now, this is a term that I'm sure many of you are familiar with, and as new traders, you've probably come across this term quite a lot, but maybe you aren't totally sure what it means, what it's referring to. So in this session, we're going to take a nice look at swing trading. We're going to talk about what it is exactly, the benefits of swing trading, some of the drawbacks as well, and we're also going to look at some examples of specific strategies that you can use and how you can manage your positions. Now, as ever, if you have any questions during the session, please just write them in the chat function and I'll stop periodically to answer them. Okay, so to kick off first of all then, what is swing trading? What is forex swing trading? So put simply, swing trading is the act of executing trades with the purpose of capturing swings in the market, hence the name swing trading. So for those of you new to forex who have heard the term and perhaps thought that it was some sort of advanced or complicated strategy, it really isn't. It's simply the act of trading with a view to capturing percentage moves in the market that are referred to as swings. Now, the distinction here is that traders operating this style of approach are looking to catch fairly sustained moves in the market. So they're looking to take advantage of directional moves, which can last anywhere from a day up to several weeks. Now, this is obviously quite distinct from other approaches such as scalping, where traders are looking to profit from the market extremely quickly, usually in a matter of seconds or minutes, and are only looking for a few pips instead of capturing large percentage moves. So what are some of the benefits of swing trading? Why would traders choose this style of trading over other shorter term, more active types of trading? Well, one of the main benefits is the relatively small amount of time that swing trading requires compared to trading styles such as scalping. Now, typically swing traders will review the markets each night and track the daily closes, placing trades each night when the daily candles close. Okay, so swing traders are typically operating on the daily candles. Now, this is distinct from other forms of intraday trading where traders will be tracking price movements on charts as low down as the 5-minute and 1-minute time frames, but even on higher time frames such as the 1-hour and 4-hour time frames. Now, using a swing trading approach also has the advantage of giving traders much more time to plan their trades. So when you're operating on the higher time frame, obviously moves in the market take far longer to play out, and so traders have more time to mark out their levels ahead of execution than if they were trading on the lower time frames where intraday volatility, news releases, etc. can mean that trading is often pretty fast and furious, and traders have much less time to plan and execute their trades. So a lot of intraday traders and scalpers are trading in a much more reactive way to the market than traders operating swing trading approaches on the higher time frames. So for example, looking at this trade then, this gives us a classic example of a setup that a swing trader might take. So we can see here that after trending down in this sustained bearish trend, we put in a bottom here, we got our correction higher, we put in this high, so this is our first initial high, we then corrected lower, we failed to break back down below that high, below that low rather, and then we rebounded and traded all the way back up to retest that high. So at the point that we got this bearish candle close at the test of this high, we can expect that we have a double top formation in play. And so a swing trader might be looking at this from a longer term perspective and thinking, okay, we've got a clear bearish trend in play here. The market has put in a correction higher. We've got a really solid level of resistance. And so a swing trader would take a short at this point and they'd be targeting a move back down to this low. Okay? So this would be a typical approach that a swing trader would take. They'd take a trade at this key resistance level at a former swing high, and they'd look to ride the market all the way back down to the next significant swing low. Now, once the trade is placed, the trader can simply check their chart each day to see how the market is moving and to simply wait until either their stop or their target is hit, or if they have any specific trade management levels, at which point they need to move their stop. So for example, the trader might have it in their rules for trading that at 1 times risk, so when they achieve 1 times risk, they move their stop to break even, or at some point that they take half off. So whatever it is, the swing trading approach allows for the trader to simply check the chart at the end of each day and keep an eye on how price is developing. So in this example, the trader is capturing a roughly 500 pip move between this high and this swing low. Now, on the other hand, we have an instance like this. So this is a 5-minute chart, okay? And you can see here we've got a really clear resistance level in this chart. Now, directionally, it's very difficult to establish a bias looking at this chart. So we've got some initial downside movement. We've got a really volatile move to the top side, which was no doubt on a news release. And then you can see that we've got this correction lower and we've been chopping around in a range. So it's very difficult to establish any directional bias. However, what a short-term trader can clearly see is that we have a clear resistance level in the market at this point. We haven't broken below this low and price is moving quite sharply higher here. So a short-term trader, a scalper, could expect that the market is going to blow past that resistance level, and they take advantage of the opportunity to capture 5 to 10 pips, say, as price blows past that resistance level. Okay, so the difference here is that the swing trader is analyzing the structure and the context of the market to build a medium-term view and is looking to take trades based upon the structure of the market, trading from a swing high down to a swing low, or alternatively from a swing low to a swing high. On the other hand, we've got the short-term trader here who isn't identifying a long or medium-term bias, but is simply taking advantage of a really short-term opportunity in the market, okay? So this form of trading is far more opportunistic, whereas a swing trader is taking a much broader view of the market and looking to take advantage of medium-term moves. Now, of course, for the majority of retail traders who work and or have families, a swing trading approach fits perfectly into their schedules because they don't have to be sat in front of their screens all day, and they can simply check the charts when they wake up in the morning and or when they get home from work in the evening. Okay, so going back to the benefits of swing trading then, the fact that so little time is required to analyze the market and to execute trades means that it fits perfectly into a lot of new traders' lifestyles. Now, for some traders, it can be really difficult to understand that this type of trading, where you're spending so little time in front of the charts, can actually generate success, because the typical idea of a trader, of a successful trader, is that of a trader working in a bank, sat in front of their charts all day, frantically placing trades. But the thing that is important to remember is that the trader in this image is a bank trader trading flow, meaning that they are simply executing client orders. So a hedge fund or another bank will call them up to place an order with them, and they have to execute the trade, filling as much of that order as possible at the best price as possible. So these traders are not placing trades based on their own analysis of where the market is going. These are called proprietary traders, and these are now an extreme minority in banking following the overhaul of regulations. And many of these proprietary traders have now left banks, set up their own funds, or are working for funds. So when asked the question, can a regular person who goes to work or who has a family actually succeed in the market by operating this type of swing trading approach, whereby they're only checking their charts for maybe an hour or so a day? The answer is definitely yes. Now, the other great thing about trading off daily charts, which I found from my own trading experience over the years, is that setups simply tend to be more reliable. So support and resistance lines, trend lines, key Fibonacci levels, candlestick setups, etc. They all seem to carry more weight and be more reliable than if you're looking to trade the same elements on the 15-minute charts or the 5-minute charts, for example. Now, of course, this isn't to say that every single setup works on the daily time frames, because they don't. However, it is far easier, one, to identify the key technical points on the chart, and then provided that you have identified the right area, generally there's a higher likelihood of you seeing a reaction from that level than on the lower time frames, where even strictly valid levels simply stand less of a chance of working due to the noise that's present on the lower time frames. So these are some of the main benefits of swing trading then. But as with all strategies and all approaches, there's always the other side of the coin. So we've looked at some benefits, but there are also drawbacks, negative side to swing trading. So while the swing trading approach allows traders to analyze and execute trades with far less time spent in front of the charts than other styles, it can definitely be frustrating for some traders that trading opportunities on these higher time frames can sometimes be a little infrequent. Okay, so typically when the market is trending and we're seeing these big directional moves, then setups tend to occur with good frequency. However, when the market enters a period of contraction and we get low momentum, then there can be very little in the way of opportunity. And sometimes it's not uncommon for days and even weeks to pass without a trade setting up. Now, obviously, in the context of a year's worth of returns, which is how traders should get used to thinking, okay, you should always be thinking about the broader distribution of your returns rather than a single period such as a day, a week, or even a month. So obviously in the context of a year's worth of returns, a few days or a few weeks of inactivity means nothing. However, it can be challenging for some traders to stick to their trading plans when they aren't getting these regular setups. And the issue here is that what tends to occur oftentimes with especially newer traders who struggle with discipline, they end up taking trades which they shouldn't, okay? So we've talked in prior sessions about the importance of sticking to your trading plan and adhering to your trading rules and only taking trades when your criteria presents itself. However, when you're going through long periods without a trade setup occurring, it can be very tempting to take unplanned trades. So in this regard, swing trading can be challenging psychologically for those traders who like taking trades and who like being active. Because one of the things that we often see is that traders who would rather take a more active approach and take a scalping approach, for example, aren't able to because of inhibiting factors that we've discussed, such as going to work or having a family, and so they take a swing trading approach because of that. However, when the trades aren't setting up, this is when those type of traders display bad tendencies and end up taking these unplanned trades and end up damaging the distribution of their returns. So it's really important to focus on your trading plan and to remember the discipline that's necessary to achieve positive returns over a time period such as a year, and to avoid getting caught out by taking unplanned trades when your trading plan isn't, when trades setups that are on your trading plan aren't showing themselves. Now, another challenge for some traders can be the required stop sizes of the higher time frames. Okay, and this is something that I get quite a lot with many new traders that I speak to, because on the lower time frames, candlesticks, for example, may be around 10 to 30 pips. So if you're looking on the 5-minute time frame or the 15-minute time frame, it's not uncommon for most candles to be around 10 to 30 pips. However, on the daily charts, it's not uncommon to have candles as wide as 100 pips and more. Now, obviously, traders should always be scaling their risk so that in percentage terms, they're always risking the same amount, whether they're risking 200 pips or 20 pips. However, again, it can be quite challenging and daunting on a psychological level to cope with these stop sizes. So many traders simply find it uncomfortable to have the market going 100 or 150 pips against them. Now obviously the stop sizes are wide, but also the targets will be wider. So if you have a 200 pip target on the daily time frame and you've got a 2 or 3 to 1 risk reward, then if you've got a 200 pip stop rather, and you have a 2 or 3 to 1 risk reward, then your target is going to be 4 or 600 pips. So the reward is much bigger as the stop size is much bigger. However, it can be challenging for traders to get their head around those stop sizes. Now, another issue that stems from the slower movement and larger swings that are seen on the daily time frame is that trades can take far longer to play out, and it can take a much longer time for a trade to reach a profit target than it does on the lower time frames. And this, I would say, alongside the infrequency of setups that can cause some traders to stray from their trading plan, I would say that the time it takes for some trades to reach their profit target is the second biggest issue for most traders attempting to use a swing trading approach. And the issue here is that it can be challenging psychologically and often end up with traders straying from their trading plans again. So let's look at an example of this and I'll talk you through what I'm referring to. Okay, so looking at this example here then, let's imagine that our swing trader is short from this level here, okay? So we've got this really clear resistance level here, we've run up, we've got a double top, we put in this big bearish pin bar and price has reversed back below that initial high. So we've got a double top with a bearish pin bar. So let's imagine that our trader is short from this level here and they're looking to take the trade all the way down to the next significant swing low, which is at this point here. Well, look at how long it would take for price to get all the way down to that target level. So the trade was taken short in roughly May, and we didn't get all the way down to our target level until November that year. So 5 months, it took 5 months for the trade to reach its target. And also, look at the price action over that time, okay? So the market didn't just sell off and head all the way down to the target. You could see that there were loads of fluctuations and retracements within the move. And just imagine briefly how frustrating it would be to be sitting through all of this chop over a 5-month period. So you get short initially and the market sells off really well. We get over halfway to target, okay, you're feeling really motivated and really excited and positive about this trade. It's going really well. And then at this point here, we get a deep correction higher that comes almost all the way back up to our entry point. Now, this would be incredibly frustrating to sit through. And for many traders, reversals such as these would have them exiting their trades, fearing that price was simply going to reverse all the way up to entry, okay? And this is something that a lot of new traders admit to. When they enter trades taking a swing trading approach, they simply don't have the stomach to sit through the chop and the fluctuation that you can see over these longer time horizons. So although the target rather, is a really handsome target at around 600 pips, the amount of time that it takes for price to reach the target and all of the chop and fluctuation that the trader has to sit through can make it incredibly difficult to hold on to a trade. So for traders looking to adopt a swing style approach, it's definitely worth considering your own personality and your own psychological standpoint and judging whether or not this is a suitable approach and whether you can handle holding on to trades like this. Now, we discussed in our last webinar, which was the stop loss and take profit webinar, just how important it is in terms of distribution of results to hold on to trades until target. And this is a great example of where that discipline would be hard to demonstrate, but ultimately extremely rewarding. So we've talked about what swing trading is, we've discussed some of the key benefits and drawbacks of this approach, but we haven't yet actually looked at any specific strategies. Now, as I said at the start, swing trading is a style of trading where we're looking to capture percentage moves in the market. So really, swing trading describes a time frame over which you are looking to trade. And like we said, it can be anywhere from a day up to several weeks. But the actual methods that you can use for entering trades in this style are quite varied, from technical elements such as support and resistance, trend lines, Fibonacci, indicators, price action patterns, etc. All of these types of trading strategies you can apply in a swing trading approach. You can also take trades on a fundamental basis, okay? So swing trading simply refers to an approach whereby we're looking to take trades on the higher time frames, capturing these large directional moves in the market, instead of taking a more shorter term opportunistic approach such as scalping. So there really are a large variety of strategies you can use, but to give you an example of some of the different approaches that can be used in a swing trading style, let's take a look at some examples then. Okay, so here is our first example then, and this is an example of using confluence between trend lines and stochastics. Okay, so the stochastics indicator shown down here, you can see this oscillating line, and this is a great measure of momentum in the market, and this helps us to find areas where price is considered either overbought and likely to reverse to the downside, or oversold and likely to reverse higher. Okay, so when the line moves above the upper threshold here, this horizontal line at the 80 level, that indicates that the market is overbought, that momentum is overstretched to the top side, and that price is vulnerable to a reversal lower. When the stochastics line is below the lower threshold, this horizontal line at the 20 level, this indicates that price is oversold and that momentum is overstretched to the downside and likely to reverse higher. Okay? So essentially with this strategy, all we are looking to do is identify price testing a trend line at the same time that the stochastics indicator is showing an extreme reading. So you can see here that we've got a really solid bullish trend line in the dollar CAD. Okay, so we've started the trend line at our initial low, we then connected it to our second low, so this gives us the trend line, and then you can see that we get these 2-3 further touches at the trend line. So focusing specifically on this area here, you can see that once we had the trend line in play and we've got a couple of touches of it, we know that the market is respecting our trend line. We then simply want to monitor price and wait for a retest of the trend line, and then look to see if the stochastics gives us the go-ahead to enter the trade. So you can see that at the point that the market traded down and retested the trend line here, the stochastics had moved below that oversold threshold, and then started to come back up again. Okay, so this gives us the go-ahead to enter a long trade. We've got the trend line providing technical support, the bullish trend line providing technical support, and then we've got the stochastics indicator registering oversold momentum, telling us that selling is overstretched and we're likely to see a correction higher. Now, if we go ahead and take a long trade off this trend line, in terms of a stop and a target, well, our stop is going to be below the last structural low. Okay, so with a swing trading approach, we're always looking to consider the structure of the market. So if we're long from this level here, the trend line, then our stop is going to be below the last structural low, which is this level here. So we'd have our stop below that low, and then our target is simply a move back up to the next key swing high. Okay, so again, we're always looking to go from swing to swing in the market. So we're long from this level here, our stop is below the last swing low, and then our target is back up to the next swing high. So this is a textbook example of a swing trading approach combining two classic technical elements and using market structure to identify both stop and take profit locations. Okay, so let's look at another example then. And actually we can stay on the same chart. So in this trade then, after price traded higher off that rising trend line and we traded up to retest that high, we actually got a great example of a short setup. So this time you can see the level that price traded back up to was actually a really clear double top formation. So we had that big first high, we got the correction lower, we then traded back up, and you can see we get that classic M shape. Okay, so this is a clear double top formation. Now, in terms of using indicators to confirm our trade once again, you can see this time that we can use the RSI indicator. Now, the RSI indicator is a great measure of momentum, the same as the stochastic indicator. And in this instance, what we're identifying at the point of the bearish double top formation is that the RSI indicator was showing clear bearish divergence. Okay? So at the point that price tested that initial high and actually pierced it and went slightly higher, you can see that the RSI indicator was showing that there had been diminished momentum in the market. Okay, so look at the level of momentum, bullish momentum, when price made that first high. We then corrected lower, and at the point that price traded back up and actually breached that first high level, you can see that the RSI indicator put in a lower high. So this is telling us that bullish momentum was weakening in the market and that a reversal lower was likely, as there was clearly less buying pressure in the market. Okay, so we can use the presence of bearish divergence at this clear technical resistance level to enter a short trade. Now, if we're short on the break of this candle low, okay, so if we're using the bearish candle that formed at the high as our entry trigger, so we're short on the break of the candle low, then in this instance, we can go ahead and put our stop above the candle high, okay, because if our theory is correct that price has formed a double top, then we aren't going to be trading back above that level, and if we do, then we're likely wrong and price is likely to continue higher. So in this instance, unless we look back to the left-hand side and we saw another high level around this region which we would put our stop behind, then we could simply go ahead and put our stop above this candle high. And then again, in terms of our take profit target, using a swing trading approach, we're simply looking to take price down to the next key swing low level, which is this level here. Okay, so we're short from the retest of this swing high, and we're trading all the way down to this swing low. So this is another fantastic example of a really simple, straightforward swing trading approach, utilizing a combination of technical indicators and simple technical chart reading. Let's take a look at another example then. So here we've got the Euro Kiwi, and what we've got here is a classic trend entry strategy, which is where we're looking to identify confluence between key Fibonacci levels and structural support and resistance levels in the market. Okay, so what we can see here then, these two red lines, okay, so this is the focus point. You can see that we had a really solid support level here in the Euro Kiwi, okay? We got a really large, significant sell-off in the Euro Kiwi here, which stalled at this point. We got an explosive move higher. We traded right back down into that low, and that low held again, we bounced. Now you can see that this support level held over several months, and we actually got another test of the level here before we got some brief consolidation, and then the market broke down below that level and traded lower. So we traded all the way down to this point here, putting in a new low before starting to recover higher. So once we identify a situation such as this, where we've got the market clearly moving in a downward fashion, we've had a break of a really clear support level, what we then want to identify is a retest of that support level, where we're looking for that broken support now to act as resistance. And to add further confirmation to our trade idea, we can go ahead and apply a Fibonacci retracement tool from the last high before the decline down to that swing low. And we can identify that the 38.2% Fibonacci retracement level lines up perfectly with that broken support. So we've got great confluence here between a key Fibonacci level and a really important structural level in this trend. So we go ahead and take a short trade from that level when price tests it and we get the bearish candle. And then again, what we're looking to do is identify structural levels for our stops and our targets. So in this instance, our stop would go above this high here, okay? So you can see that after we got that last test of the support before the breakthrough, we've got a minor recovery higher here. So we've got a small swing high, we've got our sell-off, and now we've retested. So we're anticipating that if we're correct in taking a short trade from this level, then the market isn't going to break back above this level and certainly not back above that last swing high. So our stop goes above that swing high, and then we're simply looking to take the trade all the way back down to a retest of that initial low. So again, the concept of trading from swing to swing in the market. We've retested this former swing low. We're looking to take a short trade, taking it all the way back down to that initial swing low. So again, another great example of a really simple yet effective swing trading strategy that's utilizing basic technical concepts in confluence with each other to identify entry points to the market for trades which we can then hold over several days or several weeks if needs be. So hopefully now what you're starting to see from these swing trade setups is that there are many different types of strategies you can use. Okay, so what I've done here is pick out a couple of examples that show you some of the typical ways that swing traders will combine different technical approaches to identify trades, and then how they use their trade management approach. Okay, so although we've looked at some different types of strategies combining different elements, the core principles behind the trades are always the same. So we're entering with a stop which is either behind the last significant swing high or swing low, and then our target again is the next key swing high or swing low. So the key principles of risk reward always apply here, and this is something that we need to remember, which we talked about a lot in the take profit and stop loss webinar. So for those of you who haven't seen that, definitely worth checking out that recording if you aren't familiar with the concept of risk reward. So what we're always trying to achieve with our trades is a positive risk reward, where any trade we take, the potential reward on the trade, the probable reward, is more than we're risking on the trade, and what we're aiming for are multiples of 2 and 3 times risk. So it's always important that we measure our stop distances and measure our target distances to make sure that the trade setups we're looking at have plenty of room. Okay, so we don't just arbitrarily apply these targets. So we don't just take a trade and say, right, on this trade I want to make 2 or 3 times risk. We need to consider the structure of the market and see if the setup that we're monitoring has the room to achieve these target levels. Okay, so where the potential return is less than 2 to 1, for example, then it simply isn't worth taking. Now, as we talked about earlier, the great benefit of trading in this manner in terms of using a swing trading approach on the higher time frames is that you have much more time to plan your trade and identify these key levels. And again, the levels themselves and the setups will be much clearer and easier for you to identify. So once price broke down through this support level, for example, it was simply a case of monitoring the market and waiting for price to trade back up and retest that resistance level. Okay, and you can see that resistance level as clear as day. It's a really solid level in the market. And on setups like this, where we're trading on these higher time frames, the beauty is that we can look to capture some really substantial moves. Okay, so we trade here on Euro Kiwi, which is obviously quite a volatile pair being across, so it has a much higher typical daily range. From this swing high down to this swing low, we're looking at roughly 700 pips. So these are really big trades to be making, but they're very typical of a swing trading approach where we're using the higher time frames. Now obviously the downside is that you can see that, as we talked about before, this trade took quite a while to play out, and again there was plenty of fluctuation and gyration within the trade which would have tested your resolve in terms of holding to target. So you really do have to bear all of these different aspects in mind before deciding to be a swing trader. However, as long as you apply a uniform risk approach and you scale your trade sizing correctly, and you can develop the discipline to hold your trades to target and to stick to only taking trades that are on your plan, no matter how long you have to go without the trade, then it can be an extremely effective and rewarding approach, and you can make some really huge wins from spending only a very short relative amount of time in front of the computer. Okay, well everyone, I hope that you found that really useful and engaging, and I hope that you followed along with the concepts that I've been trying to emphasize here, and I look forward to catching up with you all in the next session. So just before I wrap this up, are there any questions that I can answer for everyone? Great, okay. Well, I'm pleased that you've all followed along with that and that you found it so helpful. And as I say, I look forward to catching up with you all in the next session. In the meantime, take care and good luck with your trading. Thanks.